Hello and welcome to Property, Plant, and Equipment Part 2. Disclaimer and copyright notice. The information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2020 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So we're talking today about property, plant, and equipment, and we're now focused on this part right here, which is straight line depreciation. Okay, so if you want to learn more about some of the theory behind straight line, please go check out the very first video in this sequence. Okay, so we're going to be talking about straight line, which basically means that we're taking the same amount of depreciation every single period. So how do we go through and do straight line? So straight line assumes that those maintenance costs will be relatively the same over the period of time. Therefore, we should be depreciating the amount evenly over that time period. The formula for annual depreciation expense, right? That means how much we record per year. It's going to be my acquisition cost minus my salvage value divided by my estimated useful life. This is going to give me the annual amount of depreciation expense. So for straight line depreciation, what we want to be remembering are partial periods. If we buy an asset on August 1st and I'm recording depreciation as of December 31st, I've only used the asset for 5 months. So what I'm first going to do is compute the amount of the annual depreciation expense. Then what I'm going to do is say, okay, I used it for 5 months, or basically I used it from August 1st. So August, September, October, November, December, 5 months, multiply by 5/12. So, but what's also very important too for straight line is that even if we're using the asset beyond the estimated useful life, we cannot depreciate the asset beyond the salvage value. Very, very important. And if you look at this formula right here, acquisition cost minus the salvage value, we're really subtracting this out so we don't depreciate it. So let's take a look at our example. So I've got here, hello Sahar, Sahar's mom's class call. Of course, I'm giving a shout out to Sahar and her mom because there was a call during one of my lectures and I happened to pick it up for her and it was pretty entertaining. So she basically, SMCCI purchased equipment on April 1st, 2018 for $400,000. The equipment cost $80,000 to install and shipping the equipment to SMCCI's facility was $20,000. The equipment is expected to last for 5 years, has a salvage value of $200,000, and is expected to produce 20,000 units during the equipment's lifetime. It gives us some of these things. We're not really concerned about that right now. We'll see about that a little bit later. So we want to go through and determine the depreciation expense using straight line for the year ended December 31st, 2018, the journal entry to record that, and then the balance sheet presentation. So here's we got our question. So the first thing I need to do is, what is my formula for depreciation expense? Well, my formula for the depreciation expense is going to be my acquisition cost minus my salvage value. I'm going to divide this by my estimated useful life. Okay. So what exactly is the acquisition cost? The acquisition cost is that cost in order to get that asset ready for its use. So what it's going to include will here be the purchase price, which happens to be $400,000. And it's also going to include the installation and the shipping costs. The installation cost was $80,000. The shipping cost was $20,000. So my total acquisition cost is going to be $500,000. Okay, so right over here, it's my total acquisition cost. So the way I'm going to go through and do this is, as a reminder, this is my total annual depreciation expense using straight line. So go right over here. My acquisition cost is $500,000. I'm going to subtract out my salvage value, which is $200,000. And I'm going to be dividing this here. And again, right over here, how did I get that salvage value? Well, over here, it said basically that the equipment is expected to last for 5 years and has a salvage value of $200,000. So right over here, so I've got 500,000, which is my acquisition cost, minus my salvage value, which is 200,000. I'm dividing this over here by 5 years. Okay, so what this will be giving me is 300,000 divided by 5, or over here, 60,000 per year. Okay, so my annual depreciation expense is going to be $60,000 per year. So one of the challenges though right over here is that the correct answer for 2018? And the answer is that it is not. Okay, so for 2018, 60,000, right? But how many months did I use it for? I used it from April through December. So we're going to count on our fingers. April, May, June, July, August, September, October, November, December, 9 months. Okay, I'm going to multiply it through, and I'm going to get $45,000 per year, or $45,000 for 2018. Okay, so for the 2018, right, the amount of my depreciation expense is going to be $45,000. Okay, so as we look at this right here, right, so that's my first thing that I'm being charged with, is the amount of my depreciation expense to be $45,000. The next one is to prepare the journal entry to record the depreciation expense. Whenever I'm recording depreciation, basically the journal entry is always going to be the same. I'm going to be debiting depreciation expense, and I'm going to be crediting accumulated depreciation on the equipment. And here it's going to record depreciation expense. This is always the structure I use to record depreciation expense. It never changes. So here I'm debiting this for $45,000, crediting this for the same dollar amount. And this is going to be here on 12/31/18. So that's how I go through and do the journal entry for this one particular question. And if I go over here, that's kind of how I went through and I did the work. And here it is right over here. So again, let's do a recap. First thing I need to do is to figure out what is my acquisition cost, purchase price, installation, shipping, minus my salvage value. It's going to give me $60,000 per year. But if you look at the problem, I bought the equipment on April 1st. This value here is for a full year. Therefore, I need to multiply that $60,000 by 9/12 from April 1st through December 31st, or get to that $45,000 per year. So the next thing over here is that if we take a look at this, now we're being asked for the balance sheet presentation for Sahara's Mom's Class Call Inc. for 2018, 2022, 2023, and 2024. And usually, like when I'm asking about this, like what exactly do I mean? Well, if we have here, okay, so this is 12/31/18, 12/31/22, 12/31/23, and then 12/31/24. And my balance sheet presentation for property, plant, and equipment is generally going to be property, plant, and equipment less accumulated depreciation on that equipment is going to give me property, plant, and equipment net, right? This is the same thing right over here that Facebook is going through and doing. It's property and equipment, or I call it property, plant, and equipment, same thing. Net, what is that amount net of the accumulated depreciation? Okay, and as a reminder, what type of account, obviously this is an expense, it's going to be closed out to retained earnings. Accumulated depreciation over here is a contra asset account. It does not get closed out to retained earnings. It goes onto our balance sheet. So what we're going to be doing right over here is we know that the amount for 2018, because the beginning amount was 0, is going to be $45,000. Okay, so my property, plant, and equipment is $500,000, or which was my acquisition cost. So my property, plant, and equipment net is going to be $455,000. Well, let's go through and take a look in terms of how this actually works by going through and looking at a T account to kind of get a better understanding in terms of how this account works. So over here, for my accumulated depreciation, I'm starting out with a balance, and we bought this over here. We bought this equipment on 4/1/18. The beginning balance of this is 0 because when I bought the asset, I really had not depreciated the equipment at all. But on 12/31/18, my balance in this was going to be 0. Make this a little bit bigger. It's going to be 0 at the beginning. Plus the amount of the depreciation expense I took in the current year, for a total of $45,000. Okay, when we get to 12/31/19, my beginning balance is now going to be $45,000. Then in the current year, how much would I take in 2019? Well, in 2019, when it says straight line, I used it for the full year. So I'm going to be recording $60,000 worth. So this is going to be 60 for the current year for a total of $105,000. So this is going to be the amount of my accumulated depreciation as of December 31st, 2019. For December 31st, 2020, my beginning balance was the ending of the prior year. So this here is going to be $105,000 beginning plus $60,000 in the current year, for a total here of, we've got $165 in total. Okay, we get to 12/31/21, and over here, my beginning amount is $165. I'm going to go ahead and take another $60,000 in the current year. So this is going to be $165,000 plus $60,000, or $225,000. Now we're kind of getting on a little bit over here. So what does 12/31/22 look like? Well, 12/31/22 is going to be $225 the beginning plus $60,000 for the current year. So right over here, I'm going to have $285,000. Now, as we come over here to 12/31/22, my property, plant, and equipment, the acquisition cost, I always will generally be leaving that the same. But my accumulated depreciation as of December 31st, 2022 is going to be negative $285,000. So my amount of my property, plant, and equipment net is going to be $215,000. Now, one of the things to really kind of remind ourselves about is we're kind of getting near not dangerous territory, but I can never depreciate an asset beyond or below salvage value. My salvage value right over here is at $200,000, right? So I got to be careful. So right over here, and if I look at this also, this is the accumulated depreciation. I'm going to come down over here, and if I call this depreciation expense, the amount of the depreciation expense I took in 2018 would be right over here, be 45,000. 2019, 60,000. 2020, 60,000. 2021, 60,000. And then 2022, 60,000. But what I'm getting here when I get to 2023, I'm kind of in an interesting dilemma, because if I took right here, let's just do this for fun, 12/31/23, what if I did 285 beginning plus 60 for the current year? So that would give me 345,000. Okay. So if I took this over here, if I continue to depreciate it, okay, and here's my property, plant, and equipment net will be 155. This is the problem though I am running into. My problem is I can never depreciate below the salvage value. This net book value can never be less than the salvage value, okay? The lowest I can go is where the property, plant, and equipment is equal to the salvage value. So what I'm gonna end up doing over here for 2023 is I'm only going to be taking $15,000 of depreciation expense. Because if I take $15,000 in the current year, my total amount of my accumulated depreciation is going to be equal over here to 300,000. So my property, plant, and equipment net will be 200. And if I put that 15,000 in over here, the total amount of depreciation expense that I've taken over this period of time is 300,000. And if you think about it up here, what are we really doing? The acquisition cost minus the salvage value divided by the estimated useful life. Well, this gives us our annual depreciation expense, but this is the most amount of depreciation that we can actually take for this asset. So right over here, we've got as of 12/31/23. So what about 12/31/24? Well, even if we are continuing to use the asset on 12/31/24, I'm going to have over here 300,000 beginning, but I will take no depreciation in the current year, because what's going to end up happening is that I'm going to go beyond the salvage value or go below salvage value. So again, what this will be sitting on my books indefinitely at $200,000 until I decide to go through and sell it. So again, and this is kind of like an extreme, example, but I think it's a good example just to kind of go through and look at. So what ends up happening is that over time, my accumulated depreciation account, which is a Contra asset account, it doesn't get closed out to retain earnings. It's what reduces the property, plant, and equipment down to its net book value. So right over here, I had 45,000 of accumulated depreciation for the year ended as of December 31st, 2018, 105, and then over here. But remember, I have to stop depreciating that asset once I get to that point in time. And here's what my balance sheet presentation looks like. Remember over here, I can never depreciate beyond salvage value. So I want to thank you today for watching. Please do not forget to like and subscribe. If you have any questions, please email me at 1812cpa@gmail.com. Have a great day, and I look forward to seeing you on the next video. Have a great one.